Well, welcome back to the garden for the first talk in 2021. Today I wanted to talk about three topics. Firstly, the outlook for policy, then growth, and finally our financial forecasts. Last week, we wrote that we expected the Reserve Bank would extend its $100 billion quantitative easing program by another $100 billion, and that would be followed by $50 billion around October and then another $50 billion in April. We saw on Tuesday that the Reserve Bank did indeed announce an extension of that program. You know, they like quantitative easing. Their balance sheet, even after all of the policies we're expecting, will still be about 34% of GDP. US Federal Reserve's currently about 36%, likely to go to 45% by the middle of next year. The issue that would stop the Reserve Bank extending quantitative easing would be if they felt that there was a major disruption to the bond market, and we really can't see that happening, although it's worth noting that the $4 billion in Commonwealth bonds we expect them to purchase every week compares with about the $3 billion of new issuance by the Australian authorities. But there's plenty of existing bonds that will allow that process to go ahead. We also believe that they would curtail the term funding facility, whereby the banks are lent 3-year money at 10 basis points when the final drawdown happens in June. The Reserve Bank gave some comments about that yesterday, indicating that it would be extended if they felt that the funding conditions for the banks was becoming difficult. But we're seeing extraordinarily easy funding conditions, and I expect those to continue. So I still feel confident that the end of that program can be expected around June. Finally, we thought that the yield curve control model, whereby the Reserve Bank is committed to buying 3-year bonds at the cash rate, will be carried all the way through 2024. The Reserve Bank's a little bit more ambivalent about that. At the moment, the key will be if they announce that they're moving their bond buying program from April 2024 bonds to November 2024 bonds. The markets will be very, very closely watching this. We expect that will in fact be the case, although it's worth pointing out that the 3-year swap rate, as expected from January next year, is around 0.3%. So the markets are expecting that the movement away from yield curve control will happen earlier than we expect. The reason why I'm confident that that movement will not happen is that the Reserve Bank, along with ourselves, is focusing very much on wages. You see, inflation can really only be sustained if it feeds back into wages. And the wages growth that will be necessary to achieve the inflation target of 2 to 3% is going to be likely to be 3 to 4%. And we haven't seen that for a long time. And in fact, when we saw unemployment down at 5% before COVID, wages growth was still only around 2 to 2.5%. So it's going to take a long time to restore wages growth to that 3.5 to 4%, which would be consistent with inflation in 2 to 3%. So I'm confident the Reserve Bank will remain patient, will continue to put out that signal. But the timing at which it moves away from yield curve control is going to be the major focus for markets going forward. Commentary about the growth outlook. Look, the key there, we saw the Reserve Bank's forecasts announced by the governor yesterday that they expect growth of 3.5% in 2021 and 3.5% in 2022. That's down from their previous forecasts of 5% and 4% respectively, but it's very much in line with our own forecasts of 4% this year and 3% next year. The key determining factor for growth this year, apart from the success of the vaccine rollout, is going to be when we see the unwinding of JobKeeper at the end of March, how the Australian consumer responds to that. Now, we know the Australian consumer has a very, very high savings rate at the moment. It's almost up at around 18.5%. So when we see that impact upon incomes coming from the unwinding of JobKeeper, what we're going to be expecting to see is consumers cutting into their savings to compensate for that shock to incomes. And that is going to be dependent very much upon confidence. And that's why we're watching the Westpac Consumer Sentiment Index very closely. Now, bear in mind that last month, in December, confidence was at a 10-year high. fell about 4.5%, largely in response to the border closures and the spotted outbreaks of COVID in the second half of December. So watching confidence is going to be important, and bear in mind that 4% growth that we're expecting in this year, we're expecting 3 percentage points of that to come from the consumer. So we're going to be relying very much upon the consumer to support growth this year, rather than business, which is going to remain, whilst confidence levels are high, business is going to be cautious. They're going to want to see sustained lift in spending, sustained lift in expected demand before they start to lift their investment. Finally, financial forecasts. We hadn't changed our Australian dollar forecast since August last year, when we lifted the target to 75 cents by the end of 2020 and 80 cents by the end of 2021. Last week, we lifted that forecast to 82 cents by the end of 2021 and 85 cents by the middle of 2022. Really what we're looking at here is a lift in global risk taking. The idea that the global growth is going to be picking up, and that's very much been driven by what we believe to be ongoing sustained strength in China. We're seeing a soft patch at the moment. We're expecting the Chinese story to continue on a pretty strong path. We're in fact looking at 10% year average growth in China in 2021. We're looking at US growth to be lifting to 5% in the March, in the sort of the June, September and December quarters. And that's going to be very much supported by the US initiatives to boost fiscal spending. And of course, with the Democrats now controlling the Senate, that $1.9 trillion spending program is likely to be something that is now being built into our thinking. Of course, with that sort of a growth story, it's going to be pushing up global bond rates as well. So we've lifted our US 10-year bond forecast from 1.2% by the end of this year to 1.5%. And Australian bond rates are likely to fall in line with those forecasts. So some pretty major changes in terms of the outlook for the financial forecast, but let me say that it's been a long time since we've seen a need to change those numbers. Thank you.